Hello viewer, thank you so much for tuning in to Erimu TV where you watch and learn. We are very glad that you've continued to make you learn more and we will continue doing the same. Therefore, you can give us your feedback or maybe you call in for any question. You can do that through our SMS number which is 22518. You can also post any question or any comments on our Facebook page, Erimu TV, or even using our Twitter handle, Erimu_KE. So today we shall be looking at public limited company. During our last lesson, we looked at private limited companies. Remember, I told you that companies can be subdivided into two. That is public limited companies and private limited company. We are still on forms of business units. And today we are going to concentrate more on public limited companies, but we are going to start with the last assignment that I left you with during our lesson on private limited companies. So one of the questions that you are supposed to look at is you are supposed to discuss the characteristics of a private limited company. And the characteristics are: one, the private limited companies are formed by between 2 to 50 shareholders, formed by between 2 and 50 shareholders. Number two, public limited companies don't advertise their shares to the public. We said that private limited companies sells their shares to specific private individuals, which is not the case for public limited companies. So for private, they don't advertise their shares. The other characteristic is that they restrict the transfer of shares. So this means that the shareholders cannot just transfer their shares to anyone else without the consent of the other shareholders. So you have to consult before you transfer your shares. The other one is that they can be managed, that is, private limited companies can be managed by 1 or 2 directors. They can be managed by 1 or 2 directors depending on the size of the company. If it's not a big company, 1 director can manage. But if it's a bigger company, 2 directors also have to manage the company. The other characteristic is that it can commence its operations upon receiving certificate of incorporation, which is also known as certificate of registration. So it does not have to wait for the certificate of trading. Upon receiving the certificate of incorporation, after being approved that they can form a company, they can start their operations. This is not the case for public limited companies, as we are going to see. For public limited companies, they have to wait for the certificate of trade. Let's now look at the specific objectives for the lesson. And by the end of the lesson, the learner should be able to: 1, explain characteristics of a public limited company. Explain the characteristics of a public limited company. Number 2, you should also be able to outline the advantages of a public limited company. Outline the advantages of a public limited company. So let's first start by looking at what is a public limited company. And this one is a standard legal designation of a company which has offered its shares to the general public, and not forgetting that it has a limited liability. So what distinguishes a public limited company is the fact that they advertise their shares for the public to come to go and subscribe them. Number 2, it has a limited liability. This means in case the company happens to collapse and it incurs losses, the personal property of the shareholders cannot be claimed to repay for the bad debts. What the shareholder can lose is only what he or she contributed towards the capital. So note that a public limited company advertises their shares and debentures to the general public. Its stock can also be acquired by anyone, and shareholders are only limited to potentially lose the amount paid for the shares. So there is no discrimination. Anyone can approach a public limited company and purchase the shares or debentures. No one. It is not to specific people. It is to the general public. It is to the general public. As you can see, that is the structure of a public limited company. We have all the stakeholders, both internal and external. You can see the internal stakeholders includes the employee, manager, and the owners. The owners are the shareholders. Then you also have the external stakeholders. We have the suppliers, the society, the government, the creditors, the shareholders also. Remember, we are inviting the public out there to come in, buy the shares. Or in other words, a public limited company usually advertises its shares to the public to come and subscribe. And we also have the customers. So that one gives you a clearer picture of what comprises of a company, all the stakeholders involved in a company. Let's now look at features associated to a public limited company. And one of the features, and it's good as we go through the features of a public limited company, reflect on the features that we discussed about a private limited company, and that way you are able to come up with the differences. So one of the features is that it can be formed by a minimum of 7 shareholders and no set maximum. There is no maximum. So for a public limited company, the minimum number of shareholders that should come together and maybe agree to come up with the with the company are 7. So if they are not 6 and below, 7 and below, like 6, 5, 4, 3, 2, they cannot be allowed to form a public limited company. On the other hand, when we talk about the maximum number of shareholders, in this case, it is not set. Remember, for a private, the shareholders who should form a private limited company are between 2 and 50. For a public, minimum is 7, maximum not set. So they can be as many as they wish. The other one is that it is managed by a board of directors. It is managed by a board of directors, which is not the case of private limited companies. It is managed by 1 or 2 directors. But for a public, it is managed by a board of directors. It is managed by a board of directors. The other feature is that it cannot commence business before it is issued with a certificate of trading. And it is important to note that the certificate of trading is issued after a certificate of incorporation. The certificate of trading is issued after the certificate of incorporation. Remember what we said about private limited company? We said that it can commence its activities upon receiving the certificate of incorporation. You can see for public, that is not the case. For a public to commence its activities, it must be issued with a certificate of trading. So that is another distinguishing feature. The other one is that shares and debentures are freely transferable from one person to another. Shares and debentures are freely transferable from one person to another. And this one is usually done in the stock exchange markets. That is for those companies that are quoted, or for the quoted companies. And we refer to a company as a quoted company. That means that that company is a member of the stock exchange. It must be a member of the stock exchange. So transfer of shares and debentures for a public limited company is done through the stock exchange. Like the way in our country, It is done in Nairobi Stock Exchange. That is where the quoted companies, for example, Safaricom. If you go to the Nairobi Stock Exchange, you can purchase Safaricom shares, plus many other companies that are quoted. Remember, if I take you back a little bit, for a private, they don't do that. They don't advertise, or they don't invite the public to come and buy their shares. We continue with the features of a public limited company, and the other one is that it advertises and invites the public to subscribe its shares and debentures, and this one is usually done through a document called a prospectus. So advertising and inviting of the public to subscribe for its shares and debentures is done through the prospectus, and you'd find that in a prospectus you'll find some information concerning the company. For example, what the company owes, what is the value of the assets, as a way of trying to encourage the public to come and buy their shares. So a prospectus is a booklet that invites members of the public to apply for the shares and debentures they wish to apply from the company. And the purpose of this document we are calling the prospectus is to advertise and invite the public to subscribe for the shares or the debentures. So I've told you that the prospectus contains some information that is the relevant information that is good enough to allure or to make those who are willing or those who may be interested to buy the shares and the debentures have that wish to do so. So they have to actually know the value and the net worth of the company, because no one would go ahead to invest in a company that is poor. Let's now look at advantages of a public limited company, all the advantages associated to a public limited company, all the benefits associated to a public limited company. One being it has a wide range sources of capital. It has a wide range sources of capital, and this one we are saying so because you find that a public limited company has access to a wide range sources of capital. This is most especially through the sale of shares and debentures. We are going to look at the main sources of capital for a public limited company, and you are going to find that the main source of capital is through the sale of shares and debentures. The reason why we are saying it has a wide range of sources of capital is because since it is advertising its shares to the public, and it is welcoming the public, anyone to come and buy shares, find that they are able to collect enough. So that's why we are saying it has a wide sources of capital. We continue, and you'll also find that the other reason why it may have a wide source of capital is because anytime a public limited company wants to acquire a loan from a bank, it borrows money in huge amounts. It borrows money in large quantities, and we also find that it has a lot of assets. It is rich in terms of assets, and you see these assets are used as the security. Or in other words, we are saying public limited companies has good security to offer to the lenders as the security for the money that they may want the financial institutions to lend them. So it is easier for public limited companies to get loans from financial institutions. The other advantage for a public limited company is that it has a limited liability. It has a limited liability, and you find that in case the shareholders or in case the company happens to incur losses, the shareholders are not liable for the company's debts beyond their capital contribution. So they cannot lose more than what they contributed towards the capital of the company. So this one is an advantage, and we continue with the advantages. And the other one, The other advantages is that it has specialized management. Most of the time you find that public limited companies are rich, or in other words, since they are able to contribute enough capital, to commence the company, they are in a position, or they have financial strength that enables it to hire qualified professionals or experienced professional staff. Now we find that since they are able to do that, so they will definitely perform well, because a company that hires unqualified staff, most of the time it does not perform well because of lack of professionalism. But for a company that is able to hire qualified staff, it performs very well. So this one is also an advantage. We continue with the advantages, and the other one is that it has a wide sources of business opportunities. It has wide sources of business opportunities, and this is due to the large amount of capital that it's able to correct. And due to that, we find that even for those investments that requires huge amount of capital, a public limited company is able to invest in that. So that one is an advantage, because we find that many investors are not most of the time to invest in some areas, mainly because the capital required to commence such businesses is too huge for them to afford. But for this public limited company, it's able to do that because it has enough capital. It has enough capital. The other advantage is that there is easy transfer of shares. This one you had mentioned earlier on, that transferring shares from one person to another is not restricted. So shares are easily transferable from one person to another, and it is important to note that this one does not affect the running of the company. So sale of shares by a member does not affect the company's capital or its continuity. It cannot dissolve just because of transferring of shares, or in a situation where the shares are changing ownership. And the other advantage is the continuity. If I take you back on a partnership or the sole proprietorship, you'll find that death, bankruptcy, or insanity of a member would lead to the dissolution of the business. For a company, this is not the case. In case a shareholder passes on, or becomes bankrupt, or becomes insane, that does not affect the continuous life of the company. So this one is an advantage. And we continue. And the other one is economies of scale. When you talk of economies of scale, these are the advantages that are associated with a big company. And you find that these advantages, one of the effects of such advantages is reduced cost of production. Remember, the cost of production is the cost that you incur when you're making or manufacturing a product. And therefore, you find that public limited companies are usually very huge. Remember, even they start big companies because they have enough capital. And therefore, due to this, it is able, or public limited companies is able to enjoy what we call economies of scale operations. Now, I've said that these economies of scale leads to reduced cost of production. When the cost of production is low, we'll find that the level of profit is higher, because you find that when the cost of production is low, more goods are produced. Therefore, you are able to make more sales, and the price for the outputs are usually lower. So the public demands more of the product. So that's what we're saying. Reduced cost of production raises the level of profit. And the other advantage, that is the last but not least advantage, is that of the employee motivation. So you'll find that public limited companies have a number of programs that usually motivate their employees. And remember, when an employee becomes motivated, they work more harder. When they feel part of the team, when they feel part of the company, they work more harder, and therefore the company is able to make more profits. So for companies, you find that they have what we call purchase schemes for their employees. And they find that these schemes enables the employees to be part owners of the company. And this one usually encourages them to work more harder in anticipation of or in expectation of higher dividends. So for those companies that have such schemes of enabling the employees to be able to purchase some schemes from the company, such schemes are paid by dividends. They have dividends. So you'll find that at the end of the day, the employees looks forward to working more harder so that they can get more dividends. And this one acts as a motivation. Actually, it motivates the employees very much. That marks the end of our lesson. And I'm going to review with some assignment, which we are going to review during our next lesson. And number 1, outline 5 characteristics of a public limited company. Number 2, give 3 differences between a public limited company and a partnership. We looked at partnership earlier on. So can you compare the features of a partnership with that of a public limited company? Thank you so much for watching. And I'm going to review the quote, business quote of the day. And our today's quote says, "Actions is the foundational key to all success." Think about that. See you during our next lesson. Continue to watch and learn.